Welcome back everybody. In today's video, I'm going to break down a member's trade from the Currency Pros community. This member used the 4-hour swing strategy to take advantage of the S&P 500 in a short setup that netted him 4-hour profit. I'm going to break down this trade step by step, as well as go over other opportunities that presented themselves throughout the trading week. So let's get right into it. So we're here on TradingView, looking at S&P 500 on the 4-hour time frame. Just right off the bat, I want to mention that my chart varies a little bit from the member's chart because there's a bit of a gap here on mine. That just happens to be because I chose a different data provider on TradingView. I happen to choose Vantage because that provides the closest data to what my broker actually offers. So that's one important thing when you're choosing the chart provider on TradingView. You have to compare the prices on the right side here to what your broker actually provides so that you know you're executing and analyzing trades at the closest possible price and that everything remains accurate. Now, with that out of the way, let's get into the actual analysis behind this trade that my member took advantage of and that fit the 4-hour strategy so well. So if we just focus on this portion right here, we'll notice that it's very clear bearish momentum to the downside. The bias should be very distinctive for everyone. But if we just look to the left of it, you'll notice that there was a very long uptrend. I mean, typically the S&P 500 is always uptrending, but there are short-term selling opportunities in between. Now, what we can see here is that all the structural lows from the previous trend, such as this and this down here, have been violated by this current bearish move. So that means we can start looking for short positions. Now, within the past couple of weeks alone, there has been multiple entry opportunities on the S&P 500. We had a very clean retracement from that swing low to that swing high, and price tapped into the premium retracement levels right there. I happen to have two on my chart right now. I'm going to eliminate one just for the sake of simplicity, and we'll leave it at the 71%. But as you can see, previously there was a great opportunity here to get involved. Putting your stop loss at the high, putting your take profit at the low, that would have been absolutely smashed for a good 2.5-hour trade. Now, thankfully, the S&P 500, along with other indices and currency pairs for that matter, have been trending quite nicely recently. So as soon as this break of structure occurred after that previous trade would have hit the intended target, we're now seeing the exact same pattern repeat itself once more. So we have a very impulsive move to the downside that created a strong break of structure and left behind imbalance within that bearish range. So what can we do? We can drag our fib tool from the swing high all the way down to the swing low and simply wait for a retracement. But before we do that, we have to understand, is this a valid trade to take? Does it check all the boxes? Well, as we discussed, it did break structure, it left behind imbalance. The bias is very clear. Now we have to identify where our retracement level actually lines up within that bearish range. With this part of the trading plan, I'm not too particular. The 71%, for example, doesn't have to land directly on an imbalance or an order block or anything like that. It just has to be in the general area of it. Okay, because to me, imbalance is just an occurrence on the chart that pulls price closer to it. So it's not that I'm entering from an imbalance, it's that I'm using it as a confluence to tell myself, okay, there's a high probability of price going towards where my limit order has been set. So in this case, we can see that there's imbalance below the 71%. There's a very minor imbalance right on the 71%. And then again, from my chart on Vantage, there's an actual gap just above the 71%, sorry. So there's plenty of reason for price to trade into this general area, which means it's a good idea to set a sell limit order here and see if price is going to tag in the trade. There's a high chance that it will because of all the things that I just discussed. So let's play this forward and see how it developed. So I want to stop it right here because this is interesting. At this point here, when price kind of bottomed out there, or at least as it was on its way down towards that level, a lot of people probably would have gotten scared and deleted their limit order thinking that it's no longer valid. But in my opinion, unless the stop loss or take profit levels have been hit, the trade is still valid. We can see that that low of that wick didn't actually surpass either of these previous lows. So that means the trade idea is still intact. If anything, these relative equal lows represent resting sell side liquidity, which kind of adds even more confluence to our sell bias here. So with that being said, let's play price forward once more and see if this order gets triggered in, which it does right there. In this scenario, I've set my entry to the 71%. The member in my community set his entry a little bit higher, around here. Now, some people like to set their entry lower at the 61%, the 67%. The Fibonacci retracement is entirely up to you. And I want to clarify that the Fibonacci is not an indicator. It's actually a measurement tool. And the way that I use it and most of my members use it is to actually frame the trade. It's a predetermined entry level that you can set limit orders at, and it's a predetermined stop loss level and take profit level. It's very simplistic, it's very straightforward, mechanical, and repeatable, and that's why we do it. It's not that these retracement levels are some magic line that price has to respect. That's certainly not the case, and anybody who tells you that is lying. It's just a way to frame the trade and simplify the process. Now, as you can see, this order would have been triggered in. There's significant drawdown at this point in time, but that's nothing to be scared of. Again, the trade is valid until it hits the stop loss or the take profit. And in this case, it clearly hit the take profit. It actually barreled right through the take profit and went significantly further than the take profit. Now replay mode is off, and you can see the full extent of this bearish move. And then we could potentially see another opportunity from the swing high here to wherever the swing low happens to be placed. We could see a retracement back to the upside, and then another entry opportunity to go short and carry out this bearish trend. So I think this was a really good example, and I really wanted to highlight it. A lot of people ask me if this strategy is doable on indices or commodities, and the answer always is 100% yes. Now, I advise you to do your own testing, back testing and forward testing, to see if this strategy resonates with you and is viable for your style of trading, especially your lifestyle. For most cases, it will be, but just make sure for yourself. Rather than asking people in the comments, does this work for this asset? Does this work for that asset? Go test it yourself and see how it works for you. Now, as I mentioned, there was plenty of opportunities across the board this past week, so I want to go over a few of them to give you all greater insight into this 4-hour swing trading strategy. It can honestly barely be considered swing trading because a lot of the time these positions come to fruition within 1 or 2 days. But oftentimes it will last longer than that. In fact, my average hold time is 3 to 5 days with this specific strategy. So trade duration will vary, but the most important thing is that you just stick to the plan. The name of the game is patience. So you need to be willing to hold positions for multiple days, potentially even 1 to 2 weeks, and just let the trades do their thing. So the current example that we're looking at now is Euro USD. This was a very clean trading opportunity this week. And similar to the S&P 500, there was actually multiple entry opportunities on Euro USD throughout the past couple weeks. This being one of them right here, from that swing high down to this swing low. Now, this didn't exactly hit the 71%, but as I said, the levels that you choose for Fibonacci are entirely up to you. Sometimes I use the 67. In this case, that also wouldn't have been triggered. But again, some people use the 61, 62. In that case, this would have worked out for you. But moving on to the actual current example of price, this is Euro USD within the last few days. And this was a beautiful, beautiful trading opportunity. So as you can see, we have a drop here, a very tight upward consolidation, and then another drop to the downside. This bias is as clear as day. If you can't tell that there's a selling opportunity here, then I hate to say it, but maybe trading isn't for you. This is the most distinctive market structure possible. Within the current drop, what can we see here? Well, the Currency Pros indicator identified a break of structure right here. It's also showing us all the swing highs and lows within this consolidation. And it's showing us that the most recent swing high is right here. Now, the Currency Pros indicator is also showing us a very clear imbalance, and that happens to land right on the 71% retracement that I like to favor so much. So that's a huge confluence for me. In the last example, I mentioned how it doesn't have to be right on the retracement level, but it certainly is nice when it does happen. It's almost like a little bit of added confidence to the trade because there's such high conviction that price will make its way up to my entry area. And if my bias is correct, then that means I'm getting involved in a profitable trade. So let me go ahead and play price forward and we'll see how this played out. So right here, let me just put up the short parameter. We can see that the order was triggered in beautifully with pretty much sniper level accuracy. Let me just zoom in and show you the real details here. Again, the retracement level is not some magic number, but a lot of the time, these retracement levels that we choose, such as the 67, the 71, the 75, the 79, these are very high probability areas for price to react to. But I don't want you to rely on those numbers as a crutch. The point is we're supposed to line these numbers up with high probability things within the trading range that we're looking to target. So as I said, this order was triggered in beautifully with sniper level accuracy, virtually no drawdown whatsoever. And it came very, very close to hitting take profit, but then we saw a slight retracement back to the upside, which actually, funny enough, presented a really nice 15-minute scale-in day trading opportunity. I won't get into that in this video. I actually made a case study in the Currency Pros community, breaking that down in great detail. And it explains how you can enter swing trades and then substantially compound your profits by scaling into 15-minute day trading opportunities as well. So if you want to check that out, hit the link in the description of the video. You can join the Currency Pros community if you'd like. I go live there on a weekly basis. I share my analysis on a weekly basis, weekly recaps, and plenty of case studies with more in-depth information. So another great opportunity closed out for this past week. Now let's move on to another one because there's many examples that I'd like to talk about this week. So we've got another interesting example here, and that would be EURGBP on the 4-hour time frame. The reason I say this is an interesting one is because it kind of opposes Euro USD. And obviously they're both Euro dominant. That's the first currency in the pair. So they should be generally the same bias. That is called correlation. However, these two opportunities, even though they're opposing biases, Euro USD was short, Euro GBP is long, they actually occurred at different times, which is interesting. Let me explain the trade idea here, and then we'll play price forward and see how it turned out. So again, the model here is very simple. We have a clear break of structure to the upside. The bullish range that we're looking at left behind imbalance, and that imbalance lands pretty nicely on the 71% retracement. Again, the retracement level is entirely up to you. I prefer the 71%. I did that for a very long time. I briefly switched to the 75% to get a consistent 1-to-3 risk reward ratio, but I've been noticing lately that I'm getting missed on a lot of trading opportunities, and that's kind of frustrating. So I think I'm going to be going back to the 71% now. And a lot of our members actually use the 67% too, which is a consistent 1-to-2 risk reward ratio. And that allows you to get involved in pretty much all the trading opportunities, but you do of course sacrifice a little bit of risk reward there. So as we can see, I've drawn the Fibonacci from this swing low all the way up to this swing high. Now you'll notice that there's no arrow on this swing high yet. And you can see on all the previous swing points, I do have these arrows annotated by the Currency Pros indicator that is exclusive for Currency Pros members only. The way that the indicator works is that it needs a few more candles to solidify that high. And this is a good thing that there's a little bit of delay there, because since it needs a certain amount of candles, that kind of filters out bad trading opportunities, and it ensures that there's a proper retracement before it prints the Fibonacci range, before it solidifies the highs and the lows. Honestly, this indicator was programmed exactly how I wanted it to be, and it completely replaced my chart work. Like, I just don't do chart work anymore. I look at what the indicator is showing me, and I literally enter trades based off that, and it is a very high success rate. Now, in some instances, like this one right here on EURGBP, the retracement is so abrupt that there's no time for that arrow to print, but that's okay too, because we still understand the concept of this strategy, and the indicator still prints the Fibonacci for us. As you can see, price is very close to that order, so let's play price forward and see what happens next. So right about there, it gets triggered in, very minimal drawdown. It goes back once again, very minimal drawdown, and just kind of tests the low of that previous wick and then rejects right back up again. This is the kind of price action I like to see with those rejection wicks on the bottom side. I like to see that around the entry area. And what you'll notice next is that it pushes right through the take profit. And if I take off replay mode, you're going to notice it actually significantly surpassed the take profit level. But you can't look at this and say, oh, coulda, shoulda, woulda. I could have made so much more profit here if I just let it go. That's not how professionals trade. Okay, we can't just let it go forever. We need to have predetermined levels where we want to get in and get out, if we're right and if we're wrong. That's how professional traders operate. So it's good to set a hard take profit at the point of least resistance, which would be this swing high right here. And the stop loss is of course placed at a point of invalidation, which is this low right here. If that low is violated, that means the trade idea was wrong. If this high is violated, that means we were correct, and we get to walk away with a healthy profit and move on to the next trade. If you just hold it forever, you're going to notice that eventually that trade is going to reverse on you, and you're going to watch all your profits disappear when you could have just set a hard take profit and gotten out while you can. So again, this was another very clear, easy to execute example of the 4-hour swing strategy that you're all familiar with. Now, in my opinion, this is just as passive as trading can be. I can't think of anything more passive. You can execute this on the daily time frame, the 4-hour time frame, the 1-hour time frame, pretty much any time frame you want. Although I wouldn't go lower than that, then you need to start introducing additional time frames to anchor a higher time frame bias. But if you're using the 1 hour, the 4 hour, or the daily, you can use that as a standalone time frame and base your whole trading strategy off of that single time frame of your choice. For me, I prefer the 4 hour. We have a lot of members who choose the 1 hour. We have some members who even really swing trade on the daily time frame. Now, I've entered a lot of trades that way as well on the daily if I'm really busy in my personal life and just don't want to be on the charts at all. And a lot of the time that works great as well, but it does require a significant amount of patience. Now, last but not least, I wanted to talk about USD Swiss franc. This has surprised me over the past few weeks. This has been one of the most clean structural moves that I've seen in quite some time. In fact, most of this year has been pretty choppy for Forex specifically, but it seems like things are starting to turn around, which is a great sign. Now, typically the summer months are like that, but we can see the tide is shifting now. And, leading into the later half of the year, we start to see some more consistency in terms of structural movements within Forex. So USD Swiss franc has provided an abundance of opportunity over the past few weeks, and we're going to go over some of those opportunities today. However, it's a little bit different than the opportunities I just showed you, because this one would have missed nearly all of my 71% retracements or 75% retracements if I were doing that. Now, this is where a lot of our members who target the 67% really shined. Previously, the direction wasn't so clear. It's obviously moving to the downside, but there's a lot of choppiness, a lot of consolidation. A lot of people would have looked at this and started entering short positions just to get stopped out as price pushed back to the upside. However, within the most recent range of bearish momentum, we can see that this has all been very consistent and structurally sound. So within the first part of this range here, let's analyze where it first started to shift to the downside. And that would have been right around here. That was the first low to be taken out of this previous bullish move. And then we started seeing more lows get taken out right there as well. So this move right here was the first shift in structure. Now within that range that I just annotated, there's not really anything that I'd like to target for an entry like imbalance or an order block. Nothing really stands out to me. In fact, it is quite balanced. There was imbalance within this region here, and then that wick filled all of it, unfortunately. So in my opinion, there's nothing to get involved with there, and that's when you need to just wait and see what happens next. So we can see that we had a consolidation, a retracement back to the upside, and then another clear push to the downside. And that's when, in my opinion, the first actual opportunity presented itself. So let's zoom in a little bit there and take out the Fibonacci tool. So if you simply drag the Fib tool from the swing high down to this swing low, you'll notice that price retraced back into deep premium prices of that range and presented a great short entry opportunity. Now, in this case, it actually did peak high enough where it would have triggered, for example, the 71% retracement. As you can see, this wick would have tagged that in. But for the purpose of this example, let's stick to just the 67 because I want to showcase how different levels can be used at different times. So in this case, as I said, it would have tagged in a higher order, but let's say you stuck with the 67 this whole time. So your entry level would have been right at that line. And let's just mark up the parameters for visualization purposes. Stop loss at the high, take profit at the low, simple as that. Obviously that smashed the take profit and went significantly lower. Again, you can look at this and get greedy and think coulda, shoulda, woulda, but in reality, it is very wise and more professional to set hard limit orders at the desired levels. Now, after that move took place, we can see very impulsively to the downside, we started correcting back to the upside. This again is another retracement opportunity. If the bias is correct and the trend is strong, then you can get involved on all of these retracements. So swing low to swing high, once again, looking at the 67%, this one unfortunately would have been missed. I guess if you were targeting the 61 or 62, which a lot of people do, you would have gotten involved in this. But for me, certainly this would be a missed opportunity. I target much higher than that at the 71 or the 75. So it certainly would have been a missed opportunity for me, but this is just an example, right? We can see that this is being repeated again. We saw a very clear break of structure to the downside as price smashed through this low here. Let me just annotate the break of structures before I get too ahead of myself, right? Our first one was way back here. Very clear break of structure to the downside. We saw another one right after that. And then what happens here? Well, the Currency Pros indicator is showing it. We have another break of structure right here, okay? So the indicator, by the way, focuses on the most recent trading range. That's why I have it set so where it doesn't show all the previous break of structures because that can be very cluttered and confusing if you're trying to analyze new trading opportunities. So we always focus on the current trading range. Now, let me use the replay tool briefly and take it back to here. And we can see that this was another beautiful trading opportunity. We see a push to the downside, breaking through structure. And if we just drag the Fibonacci tool from the swing high that was created all the way down to the swing low, and again, let's say we're targeting the 67% retracement as a very modest target of a 1-to-2 risk reward ratio. Stop loss at the high, take profit at the low. Now let's play price forward and we can see that Eventually that order was triggered in with precision accuracy. I don't even know if it's going to show up on my trading view here. Yeah, that depends on the broker. This one would be very tight. You know, I'd have to move it down a little bit. There we go. That's a very, very tight entry. Depending on the broker, you may or may not have been involved in that. But regardless, let's play price forward and see how it goes. Well, you know how it goes. It pushed significantly to the downside and smashed that low as well. So this is just an example of how these Fibonacci retracements can be utilized. It doesn't always have to be the exact same level. It can be the level of your choosing. It doesn't have to be exactly what I do at the 71 or the 75%. I tend to like those more extreme levels a bit more because it provides better risk reward ratio. But with that comes the sacrifice of potentially missing trades. Now, if you target the 67%, for example, you'll certainly get involved in much more trades. But as you can see here with this example in the middle, you can sometimes still get missed on good trading opportunities. Now, that doesn't mean you should target the lowest possible level, like for example, 62% all the time, because maybe your win rate can't accommodate that. If you have like a 30% win rate, for example, then if you're targeting 1 to 2 risk reward ratios or even less, like 1.5 R, then you're not going to be profitable over time. You have to run those numbers and compare those two aspects of your trading together, the win rate and the risk reward ratio. If those two don't add up to overall profitability, then you need to tweak it and change it. Now, that's the last example for today. I really hope you guys enjoyed this video. Hopefully I provided plenty of value for you. Now, if I did, feel free to leave a comment down below. And if you haven't already, subscribe to the channel because I upload videos like this all the time. And if this style of trading resonates with you, you can click the first link in the description of this video and join the Currency Pros community. As I said before, we do weekly live sessions where you get to talk to me directly and have your questions answered. And I also provide weekly analysis, weekly recaps, and you get access to the exclusive Currency Pros indicator, which basically eliminates the need for doing manual chart work. It is an SMC indicator that prints the Fibonacci tool, breakup structure, market structure, swing points, prints imbalance, and much more coming soon, actually. So if you'd like to get involved with that, click the link in the description. If not, continue watching these free videos on YouTube because I will be pumping out much more. So thank you all for watching, and I'll talk to you all in the next one.